let's dive into a topic that might sound a bit dry at first glance, but is crucial for anyone involved in manufacturing or finance. The capitalization of manufacturing standard cost variances under US GAAP. Now, I know what you're thinking. Variances, standard costs, GAAP? It sounds like a recipe for a snooze fest. But trust me, understanding this can make a significant difference in how you manage your business's finances and ultimately how you report your profitability. So, what exactly are these manufacturing variances? In essence, they're the differences between what you expected to spend on manufacturing your products and what you actually spent. And why should you care? Because how you treat these variances can impact your balance sheet and income statement, not to mention your bottom line. First off, let's talk about the proper way to capitalize these variances. Under US GAAP, the general guidance is that variances should be capitalized if they are related to inventory. This means that if you have variances that arise from your manufacturing processes, like materials or labor costs that differ from your standards, you may have to decide whether to capitalize them or expense them in the current period. Now, here's where it gets a bit tricky. Do you set a threshold and only capitalize variances over a certain amount? Many companies do. It's a practical approach that helps avoid cluttering your financial statements with small variances that don't significantly impact your financial health. This threshold can vary from one company to another, but it's essential to have a clear policy in place. It helps streamline your accounting processes and keeps your financial reporting clean and understandable. But let's dig deeper. When you capitalize a variance, you have to decide how to amortize it. Should you amortize the entire variance based on inventory days, or do you expense specific variances right away, especially those unfavorable variances that might be attributable to abnormally low production levels? The answer often lies in the nature of the variance itself. For instance, if you have a significant unfavorable variance due to low production, it might make sense to expense that in the current period rather than capitalize it. This approach aligns better with the principle of matching revenue and expenses. And what about determining when to start amortizing these capitalized variances? Is it when you consume a portion of the inventory in the current period, or do you wait until the next period? This decision can also depend on your accounting policies and the specific circumstances surrounding the variances. Some companies choose to start amortizing as soon as inventory is sold, while others may wait until the next reporting period. The key is consistency. Whatever method you choose, stick with it and ensure it aligns with your overall accounting strategy. Let's pivot to some general guidelines concerning the categories of variation. First up, we have PPV variances, purchase price variance. This occurs when there's a difference between the purchase order price and the standard cost. Typically, these are capitalized and moved to the profit and loss statement as the inventory is sold. If you have a solid data model, the most common practice is to amortize these variances based on how quickly your inventory turns over. Next, we have variations in the process. These arise when goods undergo rework, or when your bill of materials includes costs that weren't incurred for producing the goods. Unlike PPV, these transactions generally do not increase the inventory's value and are usually treated as period expenses. It's crucial to recognize that not all variances add value. Some simply don't belong on the balance sheet. Then we have variations in yield or scrap. These occur when there's a departure from your planned standard costs, especially in actual costing systems. Generally, these variances are treated similarly to PPV variances, as they can impact the actual cost of inventory. Now, let's talk about inventory write-offs. If you find that your actual inventory is less than what your records indicate, you're facing a financial loss. You can deduct the entire variance from your taxable income, which can significantly impact your financial statements. However, if the difference between your actual and recorded inventory is substantial, you might be able to capitalize on that loss over time. There's no universally accepted definition of what constitutes significant, but generally, a variance of 25 to 50% of your total sales could qualify for this treatment. It's also essential to be aware of the risks associated with improper capitalization of manufacturing variances. Companies can sometimes be tempted to capitalize labor expenses associated with inventory. It's crucial to remember that these costs should be expensed in the same year they are incurred. The SEC has found that many businesses incorrectly capitalize expenses to inflate their annual income, which can lead to significant repercussions down the line. Now, let's take a moment to consider the valuation methods for inventory. If your records show discrepancies, it's essential to investigate whether the issue stems from different valuation methods. Ensure that your inventory count is based on a consistent criterion, whether that's the invoiced amount or the item's retail value. Imagine a simple scenario. You're a new business owner, and your standard cost indicates that you need $100 worth of raw materials to produce 10 units. But then, disaster strikes. A mishap in the warehouse leads to a spill of those materials. When you evaluate your inventory at the end of the month, you notice a discrepancy. Here's where the accounting theory of matching revenue with expenses comes into play. You might recognize half of the negative variance in the current month, given that you sold 5 of the 10 units. The remaining variance can be capitalized on the balance sheet. Many manufacturers fret about capitalizing variances when they produce more units than they sell in a given period. But here's the silver lining. If all units produced are sold within the same period, you don't have to worry about capitalized variances. The variances will offset the sales revenue from those additional units sold, allowing you to focus on meeting demand without the added stress of accounting complexities. Now, let's face it. Tracking capitalized variances can sometimes feel like more trouble than it's worth. The sheer volume of factors to consider, materials, labor, overhead, can quickly become overwhelming, especially for businesses with intricate operations. Plus, capitalized variances can fluctuate significantly from one period to the next, making it hard to gauge your financial health clearly. But fear not, there are ways to streamline this process. Consider using software to automate the tracking of capitalized variances. This can free up your time and let you focus on what really matters, growing your business, and make sure you have a solid grasp of your company's accounting policies to avoid potential mistakes. If you're uncertain about something, don't hesitate to consult with your accountant or financial advisor. Improperly tracking capitalized variances can lead to significant one-time adjustments on your financial statements, which can skew your profitability. That's why it's critical to have a robust system in place to manage these variances accurately. You want your financial statements to reflect the true state of your business, not an inflated or deflated version of reality. Enterprise resource planning, or ERP systems, can be a game changer in this regard. They can significantly enhance your efficiency and accuracy when it comes to tracking and recording variance capitalizations. Just remember to ensure all relevant data is captured correctly, configure the system to meet your specific needs, and train your employees to use it effectively. Regular audits can help maintain accuracy too. As your business evolves, your ERP system should adapt alongside it. A one-size-fits-all approach won't cut it in the long run. Customizing your ERP to fit your unique needs can help you avoid manual tracking of variances and keep your operations running smoothly. Ultimately, the process of capitalizing variances should be well thought out to avoid creating confusion. Consider the purpose, impact, and timing of each variance. By taking a structured approach, you can navigate the complexities of capitalizing variances without losing your mind in the process. And here's the kicker. Having an expert cost accountant on your team can de-risk the entire capitalized variance process. They'll ensure that all relevant data is accurately captured and provide insights into trends and variances, empowering you to make informed decisions. In conclusion, while the world of manufacturing variances and GAAP regulations can seem daunting, understanding how to capitalize these variances effectively can lead to better financial reporting and decision-making. It's about striking the right balance and ensuring that your financial statements reflect the true picture of your business. So, whether you're a seasoned finance professional or a new business owner, Keep these principles in mind as you navigate the complexities of manufacturing cost variances. You've got this.